SpaceX, listed on NASDAQ in June 2026 as ticker SPCX. The market pays $1,621 billion. Fiscal 2025 revenue, $18,674 million, up 33%. EBITDA, $4.3 billion. The bottom line, a net loss of $4.9 billion. That is the price of building Starship. 3 things the numbers say. First, the company compounds. Revenue grew from $10 to almost $19 billion. Second, operations make cash. Starship burns it. $6.8 billion came in. $20.7 billion of CapEx went out. Third, customers pay in advance. $12.1 billion of deferred revenue funds the build. The plan rests on 6 actions. Falcon keeps flying while Starship matures. Starlink shifts toward enterprise and government contracts. Terminal costs fall by a quarter. Starship capital is released only when reuse milestones are met. Spectrum clearances expand. Financing stays non-dilutive. The roadmap ends at positive free cash flow in 2030. Strengths: a near monopoly in Western launch, a reuse cost curve nobody matches, and a $75 billion war chest. Weaknesses: a $5 billion loss and heavy capital intensity. Opportunities: higher revenue per user and Starshield in defense. Threats: a launch anomaly, regulation, and the December lockup. Porter's 5 forces: launch rivalry, low; broadband, rising; new entrants face capital walls; suppliers hold little power; engines, avionics, and satellites are built in-house; buyers matter; government customers anchor the manifest; and substitutes, fiber, 5G, and legacy satellites compete at the edges. The business model is a chain. Design the vehicle, build it in-house, launch it, operate the constellation. 4 revenue streams flow from it: launch services, Starlink subscriptions, Starshield for government, and rideshare missions. Deferred revenue of $12.1 billion proves the model. Customers pay before the service flies. 4 pillars: people, engineering-led hiring, and retention through the lockup. Technology, Raptor production rates up, boosters flying more cycles. Infrastructure, Starbase expands, the pads turn faster, the satellite factory keeps pace. Digital, constellation software and network optimization. 5 risks, each with an owner. Starship reusability could slip. High probability, high impact. Starlink pricing could compress. Enterprise contracts are the answer. Regulation sits with the General Counsel. A launch anomaly, unlikely but severe. And capital intensity, real. $77 billion of net cash stands behind it. Governance is the newest discipline. An independent board majority. Audit, compensation, and nominating committees. Management certifies every quarter. The first public earnings land August the 6th. Then 10Q filings, the annual 10K, and controls undersocks. Index funds cannot buy discipline that does not exist. The macro pays for the micro. The 10-year treasury sits at 4.45%. Defense budgets expand. Billions of people remain unconnected, and the IPO window is open again. Underneath, the micro story. Western launch is effectively a one-company market. Low-orbit broadband is becoming infrastructure, and rivals are building years behind on cost. 8 machines earn the revenue. Falcon 9, the workhorse. Falcon Heavy for the biggest payloads. Starship, the full reuse bet. Dragon carries crew and cargo. The Starlink terminal on the customer's roof. The constellation above it. Starshield for government. And rideshare for small satellites. Now the deep dive. One category is more than 60% of the business. Starlink, $11.6 billion of fiscal 2025 revenue, 62% of the total, and rising every year. Launch adds another third. Together, the 2 cores are 94% of revenue. The drivers, net additions, and enterprise mix shift and cheaper terminals. The split is illustrative until the first 10Q reports segments. Now the peer group. Boeing and Lockheed Martin, Northrop Grumman and RTX, Rocket Lab and Iridium. Together, they are worth about $665 billion. SpaceX alone is worth 2.44 times all of them combined. $1.62 trillion. Now the discipline, a discounted cash flow on the plan's own cash flows, a weighted average cost of capital of 9.15%, terminal growth of 2.5%, net cash of $76.9 billion after the IPO. The answer, $7.90 per share, against a market price of $123.99. The gap is the option premium the market pays for Starship, for Mars, and everything beyond it. CFO in business issues: no buy, no sell, and no hold, ever. Stress the plan before the market does. 2 heat maps: the discount rate against terminal growth and growth against margin. The tornado ranks the drivers. The discount rate dominates, then margin, then growth. 3 scenarios frame the range: bear, 76 billion; base, 103; bull, 146. The plan bends. It does not break. 4 quarters decide the premium. August the 6th, the first public earnings. Then Starship reuse gates. Enterprise and government Starlink contracts landing in the mix. December, the lockup expires and index reviews open. And into fiscal 2027, terminal costs fall and new national markets clear. Watch the burn rate first. 8 years on 1 dashboard, 3 audited, 5 planned. Revenue triples across the arc. The EBITDA margin climbs from 23 to 36%. Net income turns positive in fiscal 2027. Free cash flow follows in 2030. Capex glides from 24 billion down to 15. The dotted line marks where audit ends and plan begins. One chart tells the story. Revenue steps up every year from 10 billion to a planned 57. The margin line finds its slope after the Starship spending peak, and the inset shows the quiet engine. Deferred revenue, 10.2 billion to 12.1. Customers paying before the product flies. Anatomy of a loss. Start with $18.7 billion of revenue. Cost of revenue takes 9.5. Research and development, 8.6. Overheads, 3.2. Financing costs and tax finish at a net loss of 4.9 billion. The cash column explains it. Financing raised 26 billion and cash still grew. The transformation map is a road. 2002, founded to make life multiplanetary. The reuse era, boosters land, and the cost curve breaks. Starlink scales into a global broadband business. June 2026, the IPO, $75 billion raised. Ahead lies the Starship decade. Full reuse. Then Mars. 9 dials sit behind the plan. Launch cadence rises. Starlink keeps adding subscribers. The revenue mix shifts to enterprise. Terminal costs fall by a quarter. Capex glides from 24 billion to 15. Research holds near 9 billion a year. Tax at 21%. A discount rate of 9.15. And customers keep prepaying. Every target has an owner. Financial. The EBITDA margin reaches 36%. And free cash flow turns positive. Owned by the CFO quarterly. Customer, subscriber growth and launch reliability. Process, more flights per booster and cheaper terminals. And learning, hold the engineers through the lock-up and certify the controls on time. The plan on 1 page. Revenue climbs from 24 billion to 56 billion. $825 million by fiscal 2030. The EBITDA line more than triples to 20 billion. Net income turns positive in year 2. Free cash flow crosses 0 in year 5. And CapEx falls every single year. The master budget breathes with the calendar. December is the peak month at 9.6%. As holiday Starlink additions land, September lifts to 8.8 on the government fiscal year close. Launch cadence stays level underneath. 12 months, $31.3 billion. Weights summing to exactly 100. 3 final charts. Quarters build to a 4th quarter peak of each budget dollar. 48 cents Capex, 34. Cost of revenue, 12 for research, 6 to run the company. Cumulative spend bottoms at $36.5 billion, funded twice over by the cash on hand. This has been the complete CFOing comprehensive analysis of SpaceX. The full report, every section you saw, is on the platform at cfoind.com. That is CFOINB.